This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Hi everyone. Hi Shane.
Hi Diana.
So I suppose we can't start this week's podcast without talking about the deal maker in chief himself, Trump making a deal with China, which came a bit sooner than markets were expecting. What do we know about the deal so far?
Well, so far so good. Looks like all gets very complicated, but basically the tariffs on China got to a high of 145%, at which point the average tariff on products going to the US was probably in excess of 30%. And then, of course, we've had a whole bunch of other things come on along the way. He first cut back the reciprocal tariffs that were announced back in April. For other countries, they were cut back to 10%. Don't forget, Australia always was 10%. Other countries well above. So they've all been cut back. That had taken that average tariff down to the low 20s, 22, 23%. Now, of course, he's cut back the tariffs on China from 145% back to, I think it's 30 or 40%, roughly, depending on how you add up the numbers, which means the total tariff on goods going to the US has fallen back to 14%. So that's the good news. The worst case scenarios have been averted. All these concerns about global recession seem to have died down a little bit. Share markets have celebrated. Fantastic news there. Aussie global shares have recovered more than 75% of the falls they had, which kind of makes me think, just that discussion we had about superannuation a couple of podcasts ago, just reminds me of just how difficult it is to time all of this stuff. Everyone would have been panicking at the bottom there, taking their money out, putting it in cash, and then they've missed out on this rebound, which has taken Aussie shares up to within 3 or 4% of their all-time highs. Similar story in the US. So far, so good. But, the delays on those tariffs are still just for 90 days. It's a pause, not the final endpoint. The tariffs are still pretty high going into the US. There's still going to be damage to economic activity. So I think it's still going to be a fairly rough ride in share markets.
But maybe not as bad as headed towards a recession, at least in the US. If the US and China can trade with one another, and Scott Besson said that they don't want to decouple from China completely, at least the two largest trading nations in the world can do some trade with one another, and the US may not slide into recession or have a very steep increase in consumer prices. I mean, we haven't seen actually any increase so far yet to consumer prices from tariffs, but it's probably too soon to see an impact given that we've only had the data up to April so far.
That's probably right. It is too soon to sort of start looking for it. I mean, it's odd when you look at what does this mean for the Feds. Trump keeps saying that Powell's a fool.
He called him too late Powell.
Too late Powell. But then I think in the same, it wasn't a tweet, it was a post on Truth Social, and then he says, but I like him, or something like that, which gives you a laugh. Trump always does that. He's good for a laugh. But in any case, you kind of think, well, on the one hand, this is good for the Fed because less tariffs means less inflation. Maybe they'll be able to cut rates sooner. The flip side, of course, is less tariffs, less hit to US economic growth. Maybe they can afford to wait longer. And that seems to be the general conclusion. I think the money markets have gone back to virtually zero chance of a June cut in the US, and that was after the Fed left rates on hold in May, and only 2 cuts by the end of the year, whereas before they were talking about 3 or 4. So all a bit uncertain as to what it means for them, for the Fed and interest rates, although I do think as we go through the second half, we will start to see the Fed cutting rates.
I guess just more generally in terms of what Trump is trying to achieve for the US, we saw this news this week. He's gotten Saudi Arabia to invest apparently $600 billion into the US. He's saying that more companies are saying they're going to invest directly into the US to bypass tariffs. Isn't that good for jobs growth ultimately?
Well, maybe it is, but maybe it's just US companies know how to play Trump. They know that if they're thinking of making some investment, or global companies as well, they know that if they're thinking of making an investment, best to go to Trump and tell him so it can be announced with great fanfare and he can add it to his list, and the press secretary, the attractive blonde, can say, oh, he's the deal maker in chief. Now he's got all this money flowing into the US, billions here, billions there, all looks fantastic. But you sort of wonder whether it's real and whether it's just a bit exaggerated that those companies were going to do a lot of that stuff anyway. as an economist, you could also make the point that it's inconsistent, that if Trump really wants a lower US dollar, some say that's what they want, and they want a smaller trade deficit, that means they can have less capital coming into the US, whereas he's actually trying to get more capital coming into the US. So what America is actually aiming for here is all a bit confusing.
At the same time, though, even in the past few months, we've seen potentially a ceasefire between Russia, Ukraine, ceasefire between India, Pakistan, some more better news around the hostages
But what happened
in Gaza.
Yeah, but the war stopped and then it all flared up again. So it's unclear as to whether he actually made progress there.
But it seems like a lot of these things may not have happened if Trump wasn't in charge. He sort of seems like the only person who can actually get these deals done. So maybe we should actually give him more credit for securing some peace in the world.
Maybe we should. Time will tell. But it's just hard to know how long. I mean, the peace deal with Gaza was there, then it was gone. With Russia and Ukraine, at the moment it looks better. But that can flare up again. We've still got issues in the Middle East, obviously, with Iran.
And even to mention the Iran deal as well, potentially.
It could. I mean, all those things, if it turns out, then that could be a good thing.
Well, at least he's doing something rather than nothing. On our own domestic policy settings, we're going to have continuation of the same, with the Labor Party now having a majority in the House of Representatives, and, well, they will have to deal with the Greens in the Senate, but at least they won't have to deal with the crossbench. So is that good news for us?
Well, I don't know. As economists, I kind of thought, well, Labor's returned more of the same, so that's less work for us as economists. Whereas if the other guys had come in, we'd have to start looking at nuclear power and all sorts of things.
And a second budget.
Yeah, and another budget, that's another blow. So it's led to quite a life in some ways. But I kind of think that the election was certainly an interesting result. Yes, people were annoyed at the Albanese government for the cost of living reasons, but they didn't see the alternative as being clear enough under the coalition. And obviously the coalition is sort of looking at ways they can do things better in the future. I kind of think that we need a strong coalition. We always need good opposition in Australia. And the role of the coalition is to highlight individual rights, self-responsibility for things, lower taxes, deregulation, smaller government, whereas that didn't really come across clearly in the election campaign. Maybe they go back to their roots. Who knows? I guess
maybe they will with their new leader.
Yeah, I mean, it's good to see a female take over as leader of the opposition. I think that's a good thing. Maybe a new world for the Liberal Party. So I guess one interesting thing is we've got this superannuation tax coming up, because, as you'd say, if we've got Labor with 93 seats in the House, that's amazing, up from 78. It's the biggest gap between a governing party and the opposition, I think, since the mid-70s, when it was the other way around, of course, with Liberals in power, Liberal National Party in power and Labor in opposition. So massive gap there. But, of course, we all know with these things, they swing around eventually. It's not going to stay that way. And, of course, once a government gets set, then eventually hubris will set in, things will go wrong, the opposition will rebuild itself, and there'll be a rotation several years down the track, could be a few electoral cycles away. But one thing, I guess, that's coming up now is that with Labor and the Greens controlling the House or the Senate, it looks like the doubling of the tax on earnings of superannuation funds in excess of $3 million will pass into law. And you did some interesting analysis on that, which basically showed that a worker starting today on average earnings, by the time they get to before they get to retirement, they'll probably be paying this tax.
Yeah, my assumptions were quite, I suppose, on quite reasonable in terms of, I just used average full-time earnings right now, super guarantee of 12%, not assuming any more contributions into super. So someone who is 22 right now, just on average earnings for the rest of their life, will reach that cap before retirement. A lot of people said, well, that's in 40 years' time, so who really cares? Because by that time, they probably would have indexed anyways. But I suppose the point is that right now, the Labor government is saying 0.5% of individuals have a super balance of $3 million or over that, and that's what matters. It doesn't matter for the individual person because on average you're not going to be hit with this high tax. But the point is that in 40 years' time, it's not going to be 0.5% of people. It's probably going to be, or what's going to be well over 50% of individuals that are going to be hit with this high tax. So
would it be way over? It would be close to
I'm being quite conservative.
Yeah.
So I suppose
there's the annoying thing I find about it though is that we've got lots of things in the tax system that are not indexed in Australia, like the income tax thresholds, the superannuation top up for low income earners, it's not indexed. The Division 293 was it excess contributions tax.
It's not indexed, but it does increase over time.
It does increase over time, but it depends on government making the decision to increase it. I mean, it just seems to me that it would be part of a good tax system that these tax thresholds are indexed. And when you look at the income tax thresholds, I think we're one of only 4 OECD countries which don't index their tax scales every year. And then we're introducing more non-indexing into other parts of the tax system.
Well, Paul Keating said that this is another form of bracket creep in the super system, which is absolutely right. So I think the way around this is basically just to say, well, we are going to index the bracket, maybe not right now, but in 10 years, 15, 20 years' time.
But don't you think that the government might have this view, well, the superannuation system is costing us a lot of money, costing the tax system a lot of money, and a lot of people have more than they actually need in super, so it may only be 0.5% today. But we don't mind that if over the next 10, 20 years it jumps to a higher number, to 1.5% in 10 years' time, or 5% in 20 years' time, and then they'll think about indexing it once it gets to a higher level. So it's a sort of a creeping tax in a way that only small it initially, people won't notice it over time, but it will gradually balloon to the point they'll get more and more revenue, and then at some point then they might index it. So it's a sort of a stealth form of...
Yeah, it's sneaky.
It's sneaky. The other problem with that tax, of course, is that it's on unrealised gains. So at the moment it's on actually realised gains, and so it's the gains the superannuation fund might earn by buying and selling an asset, or dividend flows or rent flows, whatever. If you're doing it on unrealised gains, then it could conceivably lead to a situation where, say, a farmer who has part of their farm in their self-managed super fund, or a small business that might have had some of their property in their super fund, suddenly finds they might have a cash flow problem. They've got to pay the tax, but they don't have the revenue to do that, and then they've got to sell the asset out of their super fund.
Yeah, that's a crazy part of the policy too. I don't understand at all, and I guess it's just another form of taxation for the government. But fundamentally, it's a bad policy for the individual.
Yeah. I mean, this is the sort of thing when I think about the Australian tax system, I mean, this is a lost opportunity for the coalition, that apparently there was a speech which was going to include a move to indexing the tax thresholds. And I thought that would have been an amazing thing to do, because it is a fundamentally big step towards tax reform in Australia. Unfortunately, the opposition decided not to go down that path. But they're the sort of things we need. We've just got too much in the tax system that needs fixing, but nobody seems to be prepared to fundamentally fix it.
But if we were to index the tax brackets, wouldn't that cost the budget a lot of money? I mean, basically their projections for revenue growth is based on bracket creep. Where else are they getting their revenue from?
If you look at the revenue line, it goes up over time, and the spending line stays at current high levels over the next decade, and the revenue line goes up as a share of GDP. That's all bracket creep. Now, of course, the government will say, well, if they get some surprise revenue from high commodity prices, we'll give some of that back. But that's only because they've had some good luck. But it sort of implies that if we don't get that good luck, then that bracket creep won't be given back. And it would make more sense, I think, to index the thresholds. And then if the government actually wants to maintain those high levels of spending, and spending is running at a much higher level as a share of our economy than used to be the case, then they'd actually have to go out there to voters and say, well, we're going to raise your tax rates. And the voters could decide what they want to do or not. Whereas at the moment, it's not very transparent. We get the spending announcements. People think their tax is not going to go up. And so far, so good. It's been mostly okay, but we have had this problem with bracket creep.
And I think also globally, if you look at Australia relative to other peers, we know that we have very high individual rates of taxation. But wouldn't it be wouldn't it be great if we became a global hub for talent and investment? Because we know that a lot of the places like Singapore, Dubai, that have very low tax rates actually attract a lot of talent, particularly to professional services. And that could potentially be, I mean, that's sort of, I think also what Trump and his team are also trying to do is to reduce taxation in the US, well, one for individuals, but also just to make the US a more attractive investment option, both from an individual point of view, but also from corporate.
Yeah. I mean, I kind of look at Trump and I get schizophrenic sometimes just looking at him. Is he good or is he bad? I mean, on the one hand, he annoys me intensely. You get up in the morning and you hear Trump on the rail, here we go again, another crazy comment. And he does do crazy stuff, and that creates a lot of uncertainty in investment markets and makes our life more difficult. Yeah. On the other hand, there are some sensible aspects to it. And keep getting tax rates down and keeping them relatively low, reducing regulation, all those sorts of things, I think does make some sense. And it is true that when people think, well, I'm only paying out 30% or 15% tax rate in Singapore, it attracts people to those countries at the expense of Australia. And we need to think about that in a long-term sense, particularly for millennials and Gen Z. I think you're a millennial. I mean, I could claim it's all right for me. I don't have to worry about it. But for younger people, what's going to happen is that as the baby boomers, the Gen X, they start to retire, the GST is set at a pretty low rate with significant exemptions, particularly on healthcare. And the burden of their retirement, unless they have very high levels of superannuation, actually goes back to, via the social welfare system and the tax system, to Gen Z and millennials. And we're going to have to rely more and more on income tax collections, which just seems inequitable to me. I mean, not only have baby boomers got the benefit of free university education, my son doesn't like me mentioning this, but free university education, booming property markets and so on, and Gen Z and millennials then have to pick up the tab for their retirement. And that's the reality if we leave the tax system as it is, with no indexation of the tax scales and heavy reliance on income tax. It's just going to mean more and more burden on Gen Z and millennials. Anyway, maybe we should move on to the RBA. We just got some good. Well, we've got news that inflation's coming down still. We've got weak consumer, but today, and the day we're recording this, the wages numbers came in a little bit stronger than expected. Not dramatically so, but a little bit stronger.
But still in line with the RBA's forecast. So over the year to March, wages were up by 3.2%. That was actually in line with what the RBA has been expecting. A tick up over the quarter, but a lot of that seems to be driven by award agreements for aged care and childcare workers. The private sector.
So we don't have to worry about it then, because
we do,
it's
but
not
it sort of seems
market forces. It's just government decisions.
Partly, but also I think it's not a continual increase to wages. So it's sort of a step change, a level adjustment. I mean, childcare and aged care and education. So
it's not individual contracts in the private sector where people have got higher wages.
Well, it was not clear according to the ABS. I mean, some of it was in individual agreements too, but it was linked to those award decisions. So I guess some of those contracts might have been on individual agreements as well. So it sort of seems to be a bit of both. But I suppose when you're thinking about where wages are going to end up, you're thinking about, well, what's the labour market going to do? If the labour market's very strong, the unemployment rate's low, wages growth is going to increase. But it sort of seems like the unemployment rate's not going to fall from here. If anything, it's going to increase a little bit. At least that's our own view. So it's hard to see a reacceleration in wages growth. So even though the March quarter figure was perhaps a little bit higher than economists were expecting, I don't think it's a signal that wages growth is going to pick up from here. So that's sort of, I think, the RBA will take from this, is that wages growth is still basically in line with the inflation
target.
But
what if the RBA says, well, the economy is growing, unemployment is still low, inflation's coming down, but the trim mean is still 2.9%, still too high. Wages growth has picked up a little bit. The risks coming out of America with the trade has sort of backed off, come down a little bit. So why don't just do nothing when they meet next week on interest rates?
Well, that could be an argument that they would have used in February as well. Not really much has changed since then. Actually, in February, things probably looked better because we didn't have as much uncertainty around trade. I know that things are a little bit better in the past week, but we've still had the Liberation Day announcements, and we know that the trade deal is a pause, not a complete change in the philosophy. Yeah, it could still flare up again. So I think that argument could have been used in February, and they still decided to cut rates then. So to me, the path of least resistance is another rate cut because we still have pretty poor growth. And the consumer spending volumes in the March quarter were flat to slightly negative. It's not like our GDP growth is that strong at the moment. I think that there's still a case to be made for reducing the pace of tightening. Even if we got a rate cut next week, which I think we will get, interest rates are still high relative to their more neutral or normal level, which is how I think that the RBA will look at it.
So we've got a cut in May, which is a few days' time, another one in August.
Yeah.
And then another one in February. So 3. I mean, there could be one more in there, but 3. I think one stage the money market was talking about 5.
Yeah, it was
Five
too
more cuts,
much.
which is probably a bit too much. So on that note, we better wrap up. Just before we get to that point, just to stress the bit about the share markets. We've seen a lot of volatility over the last month or two, but I think the experience just highlights how difficult it is to time markets. Who would have thought that markets were going to bottom out back in early April, just at the point when everyone was talking about it? The media was talking about billions wiped off the share market. Markets suddenly made a bottom and they've recouped much of their losses to the point that they're all at present not that far from the top. Anyway, just highlights the difficulty in trying to time investment markets and including your superannuation. So the best thing I think is always to take a long-term approach and stick to the strategy, even though you're tempted at times to do something different. So anyway, thanks, Deanna.
Thanks, Shane.
See you next time.
For more info on Shane and Deanna's podcasts and reports, head to the Insights Hub at amp.com.au.